Hello guys, and welcome to the fourth lesson of this course. And in this lesson we're going to be specifically talking about price action. So price action is simply understanding the movement in the market without any indicators, just based off candles. Usually when you see other people trade, they'll have a bunch of indicators open. They'll have the RSI, Stochastic, MACD, whatever. They'll have all of these indicators open, and they're focusing more on the indicators and what's actually happening in price. But all of these indicators are lacking. And what I mean by lacking is that they're looking at previous data and not the exact real-time data. So actually, when you're basing a lot of your setups and your trades just on the indicators and maybe a bit of price action, you are putting yourself in a bigger disadvantage than you actually think. So there are three ways that price action moves. It goes accumulation, manipulation, and expansion. And the way it goes is the market is always gonna start with accumulation. Then it will go into manipulation before finally expansion and back to accumulation. That is how the price action works. It goes in three ways. And having a deep understanding of this will benefit you majorly in your trading journey. So the first is accumulation. And that's when the market is accumulating lots of orders going both long and short. And typically the market is accumulating trades after a big move in a consolidation. So what I mean by a big move and then in a consolidation, if you look at this example here, see from this swing to that swing, that's a fairly big move, right? So after that move is made, the market is going to retrace and consolidate in this area. As you can see here, it was just consolidating and consolidating. And the reason the market's consolidating is after this move, the big initial move, that's liquidity taken out on both ends of the market. And most people would have closed their positions if they were right at the high here. So now that everything is done, there are no more orders in the market, the liquidity is taken, and the market is just there, the market will go into an accumulation phase. And this is what this is. So when the market's consolidating here and here and here, what's happening is some guys are going here thinking price is going to go lower, so they'll be opening shorts. Then when they see price over here, some traders are going to think it's going to go higher, so they'll be opening longs. So in this range, it's just a bunch of longs and shorts which haven't made a large move yet because it's just in this range. And as I said before, it's a three-step process where first is if the market has to accumulate, then there's going to be a form of manipulation, and finally distribution in line with the bias. So let's see what manipulation is. So manipulation is when price first goes opposite your bias to take out liquidity or to fill an inefficiency. And the reason the market would do this is to bring liquidity into the marketplace to be able to profit off of the move, off of this move. So before this move happens, price is gonna go take out this sell side liquidity here before offering the move higher. And the market will only move higher if the bias is bullish. So market only moves in line with the bias. Everything else is just market is taking out liquidity or filling an inefficiency. And as you can see, once the stops are hit, traders' orders would have been taken out or they would have been placed into a trade, and that's the liquidity that the market wants to get inside. So let's see what expansion is. And after the manipulation, there will be expansion in line with the bias. So if the market is bullish, it would be a bullish expansion, while if the market is bearish, it would be a bearish expansion. And that makes sense, wouldn't it? Because price will only want to reprice to that certain level where it's drawing towards. So if price is drawing towards buy side liquidity on the higher time frame, we should expect that price will reach that buy side liquidity and wipe it out. And then we drop down into the smaller time frames to identify exactly when it's going to happen. And more about understanding bias and a whole top-down analysis is going to get explained to you in the next couple of videos. And if you didn't notice yet, there's a routine happening first. There's a routine happening. The first is that it's the accumulation of trades where it's building liquidity into the marketplace. There's liquidity both going long and short. And once there's enough liquidity in the market, there will be manipulation, which is taking out that liquidity, so there is enough money in the market for the big banks and the big incorporations and all of the big traders who are trading with hundreds of $1,000,000. They have enough money to actually close their large position. And finally, expansion is where the market trades in the bias. So you can see here in this example, there's accumulation in this box right here, as it was equal highs, equal lows. So that's how this will be a small area of consolidation, and there'll be both orders going long and going short, but the market's only gonna go one way. So instead of having it that the buyers who bought in too early are also gonna be profitable, because why would they want that? They're greedy. Of course, the banks are greedy. These guys with hundreds of millions of dollars, they're greedy. They didn't get it by being selfless and giving out money to everyone. They got it by keeping their money to themselves. And that's exactly what they're doing here again. As you can see, here's our buy side, sell side. Price wicks higher, taking out the buy side. So now, those who either had their protective stop here or a limit order going long here have been taken out or been put into the market. So price will go up, trap those traders in if we're trading below these equal lows, which is typically their stops, or people will have their limit orders here going short. So what happens next? Price trades back up just for a little bit. If we're coming back down, taking out this liquidity here again, because it was also a swing low, before market goes all the way up. So now all of the liquidity has been cleared from the market, and finally the price can do what it was its intention to do. So let's actually go in the charts so you can actually see what I'm talking about. Let's go up to the 1 hour time frame, alright? And let me show you an example. Okay, maybe 4 hour would be better, be a bit more clearer for you guys. Over here would be a good thing. So as you can see, equal highs, equal lows, right? And so this would be our area of consolidation, this right here. How a regular trader who doesn't know that the market moves this way, what they would see is equal lows here, equal not sell side liquidity, equals a level of support. And at the highs here would be a level of resistance. And before I continue, let me just explain to you guys real quick what is support and resistance. So imagine this is price, right? This is how it moves. It's in an area of consolidation and it's moving like this. These equal lows here is what is support, and they consider it support because once price came back down to this level, it traded back up, and traded back up to where? To this level, which was considered our resistance. So write it here real quick. Resistance. And the reason it's called resistance because it's acting as a level which resists price from trading higher. So support, price came back down to this level, traded back up to the resistance, back down to the support, back up to the resistance. And when a trader would see price break the support, what they're thinking in their head is bias is now bearish. And the reason is that the level of support was broken. That's what the resistance and support ideology basically is. And as you guys know, it's not what's happening. That's just what the market is making seem happen, but that's not what's really happening. What's really happening is under these equal lows here, It's sell side liquidity, right? So once price goes down here, taking out the sell side liquidity, our next idea in our head is that price is either going to retrace to fill this inefficiency or to go all the way up to the buy side liquidity, which is here. Right? But regularly, what most of the time is going to happen if you're a new trader, you'll see the support getting broken, you'd open a short here, keep stop loss here. And the market knows this is what most people do. So the next thing that the market's gonna do is go all the way up to take out this resistance here. And those who went short from this support would have kept their stop loss at this high. So that's exactly how the money is coming into the market, from the uninformed traders. And same thing, as you know, here is a level of resistance. So the regular traders who are a bit uninformed would see a break of resistance and would automatically think to themselves, alright, it's time for market to trade higher. Am I right? Yes, I'm right. But we know this is not how the market works. The market knows what we're thinking. The market knows where we're gonna open our positions, where we're gonna keep the stop losses. And when I mean it knows, I mean it doesn't know specifically where you are gonna put your stop losses, where you're gonna enter, and how you're gonna enter. But it knows how the majority of the people who are uninformed traders would do it. And if I'm being honest, most of the people who trade are uninformed. They could be making money just by getting lucky. There's a small amount of traders who actually know what they're doing. And hopefully by the end of this course, you are going to be a part of that small group of traders who actually understand what's happening. And once you understand what's happening, that's when the money comes in. If you're just closing your eyes and opening either long or short and hoping for the best, it's you're gonna be tough, man. Life is gonna be hard for you. That's all I'm gonna say. You really need to take this seriously and understand what's happening step by step. Sorry guys, I'm a bit sick. But you know the grind doesn't stop. So what was I saying? This is the support, this is the resistance, and as you can see, this is how the market brings liquidity in the marketplace, and this is how the support and resistance works. And this is a keynote for you guys. Keynote. When the market's bias is bullish and price is consolidation, what you would typically see is make it a bit bigger for you guys, a bit wider. It's annoying how this comes up every time I make it wider, but it's alright. What you would typically see is when the market bias is bullish and the price is on consolidation, what's gonna happen is price will first make a run on the buy side liquidity, then take out the sell side liquidity before the market actually delivers to the higher price intended. Yeah, that's how we spell it. Intended. And how this would look is pretty similar to this. Market's consolidation, alright? And first, they'll make a run on the buy side. So now, there's going to be buyers going long who are trapped. And even though that their bias is right and the market really is bullish, they're just getting in too early. There's not enough liquidity in the marketplace for the big dogs. Let's call them the big dogs, guys with a lot of money who are trading. There's not enough liquidity in the market for the big dogs to actually make it worth their while to open a position. So market's gonna go up, trap the traders long, before coming down, trapping the sellers going short. Now once both of these trappers going long, their stops would have been taken out, and now those guys going short, their stops are going to be taking out because the bias is bullish. So now once the buy side liquidity is stopped out, there's that money in the market. Price is gonna go to the sell side, trap those traders in before finally delivering price higher and taking out the stops of those who went short here. And that's how it would look like if the market bias is bullish and you're on consolidation. This is exactly what you would expect to see. So first, market. Let's just make it so you can understand better. Buy side is over here. And here is our sell side. Goes, takes out buy side, gets them trapped long, delivers price lower. So now those who were trapped long because price hit above this buy side or this quote unquote level of resistance, which we know is not really what's happening, the traders would have been trapped long, so they would expect price to continue higher, keeping their stop loss here. Market knows this, so market will go all the way down, stopping them out. So now all of those traders who were going long and have their stops here, their money is now in the market. So price will go down, take their stops out with this swing low here, and now, because now it took out the sell side or the quote unquote support, there's gonna be people thinking price is gonna go lower. But we know that's not what's happening. It's just doing a stop hunt. And this is what this is, and that's what's happening inside this consolidation range. It's called a stop hunt. So price is gonna trade higher after the stop hunt with the actual bias of the day or the week or whatever time frame you're trading. So key thing, stop hunt. That's when market takes both buy side and sell side before doing a big move. Okay, that's enough yapping right now about support and resistance. Let's go back to our main point, which is accumulation in the charts. And as you can see here, the same thing is happening, which is happening here. Look, right? So our market bias in this example is bearish because inefficiency here, and you'll know more about it once I explain inefficiencies, and you'll really be able to piece all of this together and it's just gonna click for you. Because right now it might have not clicked for you, but once all of the content is taught and you go back into your notes and actually go into the charts, it's all gonna make sense. But for it to make sense, you have to understand the key basics and how they work before going to the bit more complex items. So this is our support, or not our support, this is other people's support, but this for us is our sell side liquidity. And quick question, guys, what's above these equal highs here? Is it resistance or is it buy side liquidity? You guessed it, it's buy side liquidity for us. So now we know how the market's bias is bullish. You know, this change in market structure here, inefficiency up here to fill, but before market went to fill the inefficiency, consolidation, which is an accumulation of orders going both long and short, and the market knows this. So first, what the market would do would take out the sell side liquidity, so would trap the traders who are going short here. Right now, when this move happened, there are people thinking markets going lower, and they're right. The bias is technically bearish, but they're just getting in too early because they don't understand the fact that there is not enough liquidity in the actual marketplace for the big banks to open positions and actually gain a benefit. So price comes down, takes out the sell side liquidity. Then the next thing, where would it be? To the buy side. And next thing would be to the buy side, right? And there's a buy, and above this buy side liquidity is our what? Our inefficiency. Price is gonna go take out buy side, go to our inefficiency, and before sending price lower, taking out this sell side here. So you can see it's a pattern, and this is how the accumulation would work. Now let me explain to you manipulation in the market, and you probably already got it. This area, let me just delete this for you so it's a bit clear. This right here, when the market's taking out the liquidity, that's what we call manipulation. Because the market is manipulating people into thinking price is going lower, but it's not. It's just to get a run of the liquidity. Same thing happening up here. In this square over here, you guessed it, it's also manipulation. So let me show you manipulation on the, just the structure of manipulation and how it works exactly. Okay, and this is how the manipulation would look. Let's say the market bias is bullish, right? So the market structure is like this, and you're expecting price to trade higher to this point, but below this is what a bunch of sell side liquidity. So what might happen is price goes up, takes out this manipulation, but it just maybe just has the wick below it, below the sell side. So it's just trapping the orders going short, but it's not actually like a real move bearish. It's just to trick the uninformed traders that the market is bearish, but in reality we know it's bullish. So that's our manipulation. It will take out those and trick them into going short before, you guessed it, sending price higher. So all of the money that the traders who went short with, they lost it, and it's now in our pockets. That's what this game is. The game is getting the money from other people's account into your account. That's basically how these banks think. And that's how we need to think, because we want to be in a position where we're trading like the banks, where we're trading like these big dogs. Because if we keep trading the way how everyone else trades, we're gonna lose just like them. And I don't like to lose. I really hate losing. It's one of the worst things in the world. And I know that many of you guys who actually bought this course and are paying attention obviously didn't buy it because they love to lose. Excuse me, but who likes to lose? No one does. Only people who like to lose are losers. And trust me, we do not like being losers. No one here is a loser. We're all trying to be winners. And opposite way, let's say we're bearish. This is how the bearish manipulation would look like. So we're bearish. Let's say there's some liquidity here. Market will go up a bit, retrace, go up, whatever. Take out this manipulation. Sorry, don't take out the manipulation. Take out this buy side liquidity. And what does that do? I'm gonna give you a second right now, and I really hope you get this right. What happens when the market is going higher to take out buy side liquidity when the market's bias is bearish? Okay, and I hope the answer that you guys got was to trap traders into thinking going long, when in reality market is gonna send the price lower. So now the buy side liquidity is in the market. So what do we have here? Money. The money is stuck in. We love the money, man. So we'll keep going lower to this sell side liquidity. So let me show you the manipulation on a different example. So now I hope you understand how manipulation works in consolidation. It's like this. And let me show you an easier example when market is not precisely consolidating, but rather just in a trend. Okay. Yeah, here would be an example. A beautiful one, actually. You can see over here, swing low, but our bias is bullish. You see, bullish displacement, shift in market structure, retracement lower, just a bit of choppiness right here in the middle, and that's alright. Sometimes the market's gonna be choppy. It's not always gonna be perfect the way you want it to be, so you just have to play with it. Swing low here before market makes this big move up here. Not really a big move, but before market makes the first bullish step into making the big move, which is this move, the market would take out the sell side liquidity here. And this sell side liquidity, let's actually go to the 1 hour time frame so you can see it clearer. Let me find it for you. Okay, and it's right over here. So what do we see? Bullishness. Market trades back to this level. And what does this level look like here to the untrained eye? Let's say it looks like a level of support. So let's just make it a bit more accurate. See the bodies of the, because look, the bodies of the candle hold more weight. So when you see the wicks, okay, keep them in your head that price when they're during that time frame. But the bodies of the candle is actually the bulk of the candle, so it holds more weight. That's where price closed at. What we see here is our swing low. So we've seen a swing low here, but market bias is bullish. Seeing price trade up to this level of support. Sorry, I mean resistance. Before price trades lower here, taking out the swing low here. As you can see, when market took out the swing low, it wasn't by a crazy move like this, which would give us like a bearish shift in market structure. It just went down right below it before quickly trading upwards. So that's our confirmation. Okay, we are right. The market just went down to take out the sell side here, this short-term sell side liquidity here, before going higher, taking out the buy side over here. You see that? Sell side, buy side, sell side, buy side, buy side, sell side, buy side. That's how the market moves. Price retraces back down, order block, before going all the way up with this big beautiful move. 70 pips, 73 pips. And if you caught this in a day, like look, in 10 hours you can catch 70 pips. And that's fantastic. That's great. That's it. You don't look at the charts anymore for the whole day. Once you caught 70 pips, you take the day off. Go have some lunch, go have some dinner, go enjoy yourself. Because you just put in a good day's work catching 70 pips. So, I got a bit sidetracked. So when price is trading below this low, and the bias is bullish, this is our manipulation. This is market tricking those into thinking it's going lower, when in reality it's going higher. And that's the manipulation. Before our expansion. And you guess the expansion is pretty simple to understand. This right here is our bullish expansion. So what do we see first? Consolidation over here, right? The market is just building orders. Price came, took out the buy side before taking out the short-term sell side. That's our manipulation happening right here. Price traded above the buy side. That's more or less our confirmation that we are okay, we are right, we're good to go. We'll wait for a retracement into our key area. Our key area in this example would be the gap in the order block here. You'll learn more about it, don't worry. And then so price will just shoot up as our expansion. That's our bullish expansion. And the way this goes is in 3 ways. First we have consolidation, manipulation, and expansion. And this is how the market would move that way. It moves in a cycle. Let's say like this. First, market starts as consolidation, then it goes to the manipulation. Then from the manipulation, market expands. Then from the expansion, back to the consolidation. But forget consolidation, it's more accumulation. It doesn't necessarily have to be equal highs and equal lows. It can just be where price is choppy. So accumulation, manipulation, expansion, back to accumulation. That's how this works. As you can see, what do look, accumulation, this whole area right here is what this is our accumulation. Once price accumulated enough, we would have our manipulation by price taking out that swing low, manipulation, followed by our bullish expansion. And this is all flipped bullish and bearish. Everything I'm saying bullishness, it works the same bearish. You just have to flip it the other way. Bullish expansion, price trades up higher here, Now, what do we have here? Same old, same old. We have our accumulation of orders. Yeah. And we can have maybe the manipulation here. Took out the sell side for taking out the buy side for expanding lower. And that's how the market works in those three different ways. It always starts with an accumulation of orders, and during this accumulation of orders, that's where the money is gonna get put into place. So let's write it out here. Our accumulation market always starts off in accumulating trades. This is actually how the market gets the money into the marketplace. Because when you win a trade, like, where's that money coming from? It's not coming from my pocket. It's not coming from someone else's pocket. It's not coming from your broker's pocket. It's coming from the mass majority of uninformed traders' pockets. That's where the money is coming from. And it's coming in the form of buy side liquidity and sell side liquidity, or buy stops and sell stops. So that's what accumulation is. It's just getting the money into the marketplace. Next, we have our manipulation. And this is when price reaches a certain level which traps traders either going long or short, and securing their money in the marketplace. So now, after the accumulation, where the orders have been put into place, manipulation is when price actually gets that money secured into the market. That's what the manipulation is. And so once that money is secured, what's the next thing to happen? Expansion. So once the market has secured all of the liquidity, next logical step would be for price to expand in the desired direction. So let me just put this all together here. First, accumulation, manipulation, expansion. This is basically how price action works, and this is why liquidity is very important, and why understanding where liquidity is and how market's gonna attack the liquidity and why it's doing it is very important, because of these three key factors. And after an expansion, price will go back to an accumulation before starting the cycle all over again. And this is how the cycle works: accumulation, manipulation, to expansion, back to accumulation. It's very important that you understand what area that the market is trading in right now, because the worst thing that you can do is think that market is in expansion when in reality is just in manipulation. If you get that wrong, then the market's got you. The market is just gonna take your money and you're gonna lose. That's how it is. Or the market's an accumulation. What you don't know is an accumulation. You think it's just doing expansion, and then again you're gonna lose. Right now you're thinking to yourself probably, wow, what does this guy even mean, man? How can I not know market's an accumulation? How can I not know it's an expansion? It seems so easy right now when he's explaining it to you. And that's how the market gets you. It does seem easy, and it will become easier over time, but what you need is experience in hours actually spent looking at the charts to gain what's going on. Like as you can see here to the right in my red list, I only trade 4 different currencies, and from these different currencies, I'm only trading 3 of them really: Euro USD, GBP USD, USD JPY. I keep USD CAD here just as a bit of an indication of what's going on in the US markets and the Canadian markets, but I wouldn't say I'm a necessarily heavy trader of them. And each one of these pairs have their own personality. They all have their own little thing. Like Euro USD. Sorry guys. So Euro USD, something I notice about Euro USD is that it typically goes a bit slow. It goes a bit slower to what GBP USD is doing. But what's nice about that is when because Euro USD is going a bit slower, you really get to see what market is actually doing. Like you really get to understand. But GBP USD is a bit faster, and USD JPY is just a machine, man. Like when USD JPY really wants to go higher, oh my goodness, it's gonna go higher. But if it really wants to go lower, it's really gonna go lower. But if USD JPY decides not to move, it can be weeks of market just going up and down 10, 20, 30 pips. So that's what I mean by they all have their own personalities. And once you actually go and spend time looking in these charts, you will see what I'm talking about. And quickly over here, what do we see? What do we see before this big move down? Equal highs. Market bias is bullish because it already took out the buy side liquidity over here, right? So khalas, once the buy side liquidity is taken, the next step is to take the sell side liquidity. Once something is taken, once the buy side is taken, or once an inefficiency has been filled, there's not gonna be any reason for price to stay at that level. Price is gonna go to the next logical area of interest. So took out the buy side. Next thing we're looking for, taking out this sell side here. Am I right? Yes, I'm right. Sell side, sell stops. Right, so that would make our bias bearish because we're expecting price to take out this sell stop here. Price comes back down. When price goes down, retraces back up. When on the retracement back up, it made these equal highs over here, if you can see them. And these equal highs have liquidity above them. So before price actually trading lower, what happens here? Price has a wick, a strong wick above that, taking out these buy stops before sending price, you guessed it, lower to this sell side. Took out the liquidity. That's our manipulation before our bearish expansion to this area. So, and as you can see, once price took the sell side liquidity, it didn't stay here. Ask this price level how its day doing. What, is there anything new? No, that's not what the market does. Market took out the sell side. Next thing is to go up to fill this inefficiency here. Went up, filled the inefficiency, and once it filled that inefficiency, because our market bias is still bearish, price went up, filled the inefficiency. Market bias is still bearish because we have not seen a reason to think it's bullish. We would see a reason to think it's bullish if price didn't stop here when it was trading and instead traded higher to this point. That's when we would think that the market switched, right? So market came down, you guessed it, till where? Oh my, what's going on? You guessed it, the market went down to below this swing low over here. And that's what's happening. So let's go back to the lesson and see what we have next. Displacement. You've probably heard me talk a lot about displacements, and now finally I'm going to explain to you what a displacement is. So first, a displacement is a strong one-sided candle, meaning a bullish displacement would be a strong up-close candle, and while a bearish displacement would be a strong down-close candle. And the significance in a displacement is that is the market giving you an idea on where it wants to go. So a bullish displacement is this right here, this long candle, long strong black candle is our bullish displacement, and over here our bearish displacement would be this long and strong red candle. Okay, And the importance of a displacement is this is what causes inefficiency in the market. So if you go back here, let me clear all of this. So if you go back here, right, let me find you an example. Okay, this there is displacement, right? So as you can see, strong one-sided candle, lower, bearish displacement, all of this. So when price has a bearish displacement, what that means is there's an inefficiency in the market. Inefficiency in the marketplace. And where is this inefficiency coming from? It's coming from price only delivering one side lower. As you see here, price didn't go down and up like here. See here, it went down, back up, down, back up. That's a balanced market. But this is an inefficient market because price only produced one way, and that way was down, right? So that is a bearish inefficiency. So we would expect price to eventually come back to fill this inefficiency, as we see here. Price came back, filled the inefficiency before trading lower. And as you can see, price came to fill the inefficiency and quickly traded lower. Quickly. And that's our bearish displacement. It's a strong one-sided candle. Now let me find you a bullish displacement. This is a perfect example of why bias is important. This here is a bullish displacement. Strong one-sided candle higher, right? But when price came back down to fill it, it didn't go back up. And why would that be? There's always a reason. It doesn't just happen to happen. There's a reason to happen. And I can just, before I even look at the other side of the chart, I can almost guarantee you that price, when traded up to this level, somewhere in this square here, somewhere over here, there was a large pool of buy side liquidity to the left. And let's check. Am I right or am I wrong? We look here, all the way here. Take it all the way back. What do we see? What do we see here? Price traded above. All of this is equals highs. And this is equal highs on the 4 hour. So there's lots of liquidity up there. Price traded up there, taking out this buy side liquidity, and trades into the order block level here. Let me just mark it out. Let's go back and let's see. Wow. Took out the buy side order block, crashing down. That's it. That's why this displacement doesn't work. It all matters on the bias. But this displacement here would work as our bullish displacement. Because, you see, price. You know what? First let me just show you the expansion. So here's the displacement, and this also is displacement, right? So the inefficiency here, and the reason it's an inefficiency, the reason a displacement is called an inefficiency is because price traded only to one side and didn't offer to trade in the other side. Offer to trade the other side. So if we have a bullish displacement, that would mean price only delivered to the buy side and not the sell side. And the opposite if we have a bearish displacement. If we have a bearish displacement, that would mean price only delivered to the sell side and not to the buy side. So that means that the market is going to be drawn to fill that level of inefficiency. So here we can see strong bullish displacements higher, right? And our bias would be bullish because look, if you look closely here, the market didn't really trade above those highs. صح? The market didn't really trade above these highs right here. Let me change it from the wick candles to the line. Yeah, price did not trade above this liquidity point up here. There was this big displacement taking out this swing high, this swing high, this swing high, right? So price, we expect price to be bullish until when? Until of this liquidity point here, until price trades above it. As you can see, price didn't trade. Let me just drag it out. So as you can see, with this displacement, price didn't trade above this high or these highs marked out here, right? So we can still expect that price didn't do its job fully. So price needs to continue going higher, take out this liquidity, before filling the inefficiencies to the left, reacting to the order block before going down. Right? So we get our retracement here into this order block for price. Goes a bit higher, retraces back down, fills this bullish inefficiency order block as well for going higher, taking out this sell side liquidity here. And once we've seen this, it doesn't mean okay, let's automatically, okay, that's it, price hit it, we're going bearish now definitely. No, that's stupid. We need to see something which makes it bearish. Because let's say that you think you're a superhero trader, you've seen price take out this buy side, okay, let me go short right now, let me go short. You would go short, and guess what would happen to you, buddy? You would lose all your money, buddy. Because look, kapow. How many pips is that? 110 pips higher. If you automatically in your head think that it's time to go short because of that, you're really missing out on all of this potential long gain. And yeah, that's what the displacement is and how it works. And it's important that your displacements you're looking for is in line with your bias, because this also here is what it's a bearish displacement, right? Strong one-sided candle down, but price didn't just trade up to the imbalance before going lower. It just kept going up, didn't care about it. And the reason it didn't care about it is because market is bullish. That's why. So let's see what the next thing is, and it's called a fair value gap. And a fair value gap is a 3-candle formation when the wick high of the first candle and the bottom wick of the third candle do not meet. So what that means is you're creating a gap in between them. As you can see here in this bullish fair value gap, we have our candle number 1, our candle number 2, and our candle number 3, right? So the wick high of the first candle is here. We'd mark it out with this black line, and the wick low of the third candle would be here, and we'd mark it out with this line. So all of this place here is what is our inefficiency. This is inefficient because market did not offer price to go lower, it just went in one direction. And same here to the bearish for value gaps. You see candle number 1's low, we'd mark that out. Candle number 3's high, we'd mark it out. This whole area here, as you can see, it's a gap. There is no wick, there is no price. It's just price delivering one side lower. That's why it's called, it's inefficient. Market will need to trade back up here. And the importance of the fair value gap, as I said earlier, is that it's inefficient in the market. Because price only delivered one side. So price will need to come back up to fill the gap before continuing in that direction. So let me find you the gaps. Okay. Look, right here is a gap, for example. And they usually find gaps in displacement. Not necessarily, but a lot of times there'll be a gap in a displacement. So let me just mark it out for you real quick. This is candle number 1 over here. It's a 3-candle formation, remember. Just write number 1 instead of candle number 1. This is number 1 here. Number 2 over here. And this one right here, the one with the high wick and a low wick, is the number 3. So this is a bearish fair value gap. So what we're looking for is the bottom wick of the first candle, and here it is. Make this black. And the wick high of the third candle, which is here. As you can see, this whole area over here is a gap because price did not trade there. Like at this point, imagine none of this, imagine everything to the right here didn't happen yet, and it's just this fucking, excuse me, and it's just this gap here. This is inefficient because price did not trade up. There's no wicks, there's nothing. It's a whole gap. It's empty. That's why it's called the fair value gap. And this is an inefficiency in the market. And when we see inefficiencies in the marketplace, keynote, when we see inefficiencies in the marketplace, what we would think is that price eventually has to reach that level before continuing down or reversing, continuing in that direction or reversing. Okay, and you can see here with this wick, look, I'm telling you, it's all the same thing happening, the same thing happening over and over again, man. Look here, swing low, right? Sell stops under it, price wicks down. What's the next target? Buy side liquidity over here. But what's above that buy side liquidity? A gap, an inefficiency. So what is price gonna do? Manipulation comes here, taking out the sell stops over here. So first thing, manipulation, taking out the sell stops, taking out the sell stops. Next target is our buy side, because that's how the market moves. Next target is our buy side, which is here at this black line over here, because of these equal highs right here, if you can see them, right? But above our buy side we have a bearish fair value gap, FFG for short. So an expectation can be made that price will trade above the buy side liquidity, BSL for short, buy side liquidity, above the buy side liquidity to fill the bearish FFG, to fill the gap. And what I mean to fill the gap is price actually trading up into the gap to fill it. So price took out the sell side, went up to the buy side, went all the way up to fill this gap. And what happened when price filled this gap? Quickly rejected price going higher and went all the way down. Not all the way down, it went down 78 pips. That's very good. This is on the 4 hour, don't forget. If you go daily, you'll find gaps there. You go weekly, monthly, yearly, you're always gonna find gaps. But it just takes more time for price to actually deliver if it would go on the higher time frames. And yeah, that's what a bearish gap is and the importance of it. So let me find you a bullish gap. Same here, bullish gap here, there's a bullish gap here. Let's take this example. Gap here, gap here. And you'll find multiple gaps usually, like back to back. And that just means that the market's inefficient. So market went up, created these gaps on the way, right? Market came back down, filled those gaps, traded below these equal lows. Not below the swing though. Traded below these equal lows. Could be our form of our manipulation for price traded up higher. But let's actually go in the hourly of this whole section to see what's actually happening. Okay, let me just delete this. So what do we see here? Gap, price came, filled the gap, retraced a bit higher. Here it made a bearish gap, if you can notice. See, bearish gap from this wick to this wick. Just keep that in mind. And price traded lower. It filled all of the gaps, went down here to the midpoint of an order block for trading higher. But as you can see, price traded higher and it filled the gap right here. It fully closed this gap here. And the reason this is a bearish gap, same thing. Candle low, first candle low with a third candle high, it's a gap. And this doesn't really count as the gap being filled because it's just like a little bit. You need to see like a real move, like a determined move to fill the candles. So price came down. Remember, our bias is bullish in this fractal. So price came down, went back up, filled the bearish gap. And once price filled the bearish gap, as you can see, it had a little retracement lower. To fill what gap? This bullish gap here. And the reason it's a bullish gap, same thing. High of the first candle, the wick high of the first candle, and the wick low of the third candle creates a gap in the middle, creating an inefficiency in the marketplace. Price came back down, filled the gap, took out this buy side liquidity here before going lower, taking out this sell side liquidity here before finally making a strong move, taking out this swing high here to the left. As you can see, market was accumulating trades here in this little area, right? And then filled the gap, filled the inefficiency, went up higher, took the buy side to get the liquidity, went lower, taking out the sell side. This is our manipulation happening right here. Manipulation is happening in this block. Price went up, look, filled this gap here, filled it almost perfectly. Let's see it, let's just zoom in a bit and see it. This is our wick low of the first candle and wick high of the third candle. Gap here in the middle. Price took out the liquidity, went up to fill the gap, then had a bit of downward pressure because it is a bearish inefficiency at the end of the day. So you can expect price to retrace, but don't forget that our bias is bullish. So our main goal is seeing price going higher. All of this is just like background noise. It's just happening in the background before price can actually show us this real hand, what's really gonna do. So price took out, filled the gap, retraced a little bit to here, and then before price went all the way up, 70 pips, taking out the swing high. And as I said earlier, just because you take out the key level doesn't mean you automatically switch bearish. You need to see something which makes it bearish. So look, price went up, taking out that high, right? It took it out here a bit before it retraced and trading up higher, taking out this swing high here. So what that means is market is continuing in the bullish market structure. It's continuing, as you see, high, low, high, low, high, low, high, low, high, low, high, all the way high, low. So this is the same thing, higher highs and higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. This is a higher high, but this would be a higher high, but it's alright because look, the low stayed intact, didn't get broken. So that's what a gap is and the importance of it. Let's see what the next thing is. Next is an order block. And an order block is the last opposite closed candle before a strong move in the other direction. A bullish order block would be the last down closed candle before a bullish displacement, while a bearish order block would be the last up closed candle before a bearish displacement. And the importance of the order block is that price typically respects order blocks that are in line with the bias. Meaning if there's a bearish bias and its price is retracing up into a bearish order block, it is likely that price will continue trending lower after being at the same level as the order block. So you can see here, this candle right here is our bullish displacement, creating a bullish fair value gap. We'll just keep that to the side for now. And here are our last down closed candles, our last red candles before a bullish move higher. So these three candles would be considered one order block. It's not just this candle, these three all together. And what we see here is that price goes up, comes back down to fill the gap, right? And in this example, our bias is bullish. So price goes up, comes back down to fill the gap. Look at this. exactly at the body of the order block. As I said, the body holds more weight. So price comes down to the body of the order block before quickly going up. So it's showing respect to the bullishness and to the bullish order block. And here we have the opposite of the bearish order block. We see here are the last two up close candles before a bearish displacement. And this is the body of the order block. You have it marked out with this black line. Price went down, went back up a bit, down again, went back up to fill the gap, and then price is at the order block level. Look, notice carefully. Look at all of the bodies of this candle, this candle, this candle, this candle, and this candle. All of the bodies of the candle are respecting the body of the order block. See this wick high? Yeah, it went a bit high. But did the wick high trade above the bearish order block? No, it didn't. It still respected it. It's still lower. So let's go on the charts. You can actually see how this works. Let's clear all of this. And let's go. Yeah, right here. So this would be our bearish order, our bearish order block, because it's the last up close candle before a bearish displacement. So let me write down the definition here so it's a bit clearer. Bearish order block. Bearish order block is the last up close candles before a displacement lower. So in this displacement, what is the last up close candle? It would be right here. And price has a tendency to respect this bearish order block, and if the market bias is really bearish, when price trades back up into this order block, it should trade lower. So this is our order block over here, and what do we see happen? Displacement lower, price trades back up to fill, this gap over here. Small gap, well, gap's a gap. Trades a bit higher than the gap to the order block level before price trades lower. So that's what the order blocks are. That's what a bearish order block is. Now let me find you a bullish order block which is in line with the bias, because this here is a bullish order block. Well, I'll come back to this point. I'll come back to this. Let me just find you a clear example of a bullish order block. This is the real-time charts, so I do have to go a bit back to find it. Yup, and here it is. Here, bullish order block, as you can see. Where did the price go up to? To here. So you can, as I mentioned earlier, the body holds the most weight. But typically, if we drop down to a smaller time frame, in this, you'll actually see it probably react to a cleaner level. So let's just make sure, because I think that's what's happening right there. And is it? Yeah. So this would be our bullish order block, and the reason it's our is because it is the last down close candle before a bullish displacement. Before a bullish displacement. So you see, this is the wick. As you can see, the wick low, yes, it did trade pretty low, but it didn't trade lower than the order block. This is the low of the order block, and that comes in at 1.0862, and this low here is 8626. This is 8623, 8626. This was 0.3 pips higher. Let's just see, yeah, 0.3 pips. So that really trade below the order block, so it still has some respect, and it's just a wick. You can see the bodies are not that close to the order block, so just wick down before trading higher. And there's a reason that price just went to respected this level, because it's our bullish order block. So price will come down into the order block before trading all the way higher. And let's go back to this point over here. Where was it? It was on the hourly. Yes. So here is our bullish order block, right? Same thing, it's the last down close candle before a bullish displacement. But this bullish displacement, what was the reason behind it? The reason behind it is just to take out this buy side liquidity, and that's the reason behind this displacement over here. So price is gonna come back down to this order block, and what happens next? Price trades higher. We expect it to trade higher, whether the bias is bullish or bearish, but higher to what extent? That's the key, because our bias isn't bearish. Our bias isn't bullish. It's pretty bearish, because it just took the buy side liquidity out from an area of consolidation, and we expect price to reach this sell side here. That's what's happening right now. It's very important to be in line with your bias and apply the bias to what's actually happening with you using price action and market structure. So price took out the buy side, came back down to this bullish order block before going back up to where, you guessed it, this more important bearish order block, because it's in line with our bias, and that's what makes it important. You're gonna find order blocks every 10 minutes, but not every 10 minutes is gonna be an order block that you want to use. You would typically want to use order blocks on the bigger time frames, right? What order blocks to use? Let's see right here. What order blocks to use? You would want to use order blocks which are made in the higher time frames as it holds more weight. And you would use order blocks which are in line with your directional bias. Meaning, if you're bullish, you're not going to be paying too much attention to bearish order blocks. You'll just be paying more attention to the bullish order blocks because it's in line with your bias. But that doesn't mean the bearish order block doesn't have any use. Even if you're bullish, it has very minimal use, but it's still some use. Like an example of a bearish order block when you're bullish would be, that could be a good reason to close your position because price is now back at the bearish order block, so you can expect a bit of retracement higher, right? So instead of waiting for the retracement and hoping that price goes down from that retracement, because not everyone is right. You might think like this is gonna happen for sure and it just doesn't. Better to be safe than sorry here. So price, once you see price at a bearish order block when you're bullish, it could be a good idea to expect a retracement. And if you're in a position, you would want to see drawdown of your position, you would close a position at the bearish order block level. So that's what the order blocks are, and I hope you got that. And one more thing to mention before I forget, it's not just the one candle, it can be multiple candles. So what I mean by this is, over here we have our bearish order block, but it's not just this candle, it's these two candles. It's the last consecutive, let me write it down. Order blocks are the last consecutive, candles which happen to go against your bias. No, not against your, most of the time happen to go against your bias. Meaning if you're bearish and you see a bearish order block, that would be an up close candle. That would be a bullish candle, would be your bearish order block. And the opposite, if you're looking for a bullish order block, it would be a down close candle. And the final thing we have for this lesson is breaker blocks. And what is a breaker block? And it's basically the point in where the shift in market structure has happened. And we've learned about shift in market structures in the previous lesson, and that's when there's a displacement above a certain swing high or a swing low. So let's say there's a swing low which got violated with a bearish displacement. The first thing that means the first thought that we should have in our head when we see a swing low get violated with a bearish displacement would be that the market is looking bullish, that there's a bearish, that there's a shift in market structure, bearish, there's a shift to the downside. So the swing low which got broken would become our breaker block at that level. And the opposite, if we have a swing high which got violated by a bullish displacement, then the swing high would be our bullish breaker. And the importance of the breaker block is price typically retraces after displacement, and if we see price retrace into our breaker block level and our bias is bullish with that displacement, that would be a good idea to go long. That's a good way for price to continue repricing higher. So let me go on the charts and show you exactly what I'm talking about. Let me clear all of this. Let's go to GBP USD. Let's switch it up a bit because I got bored of Euro. Why can't I clear? What's going on? What's going on, man? Remove drawings. Alright. As you can see, market has been very choppy recently. Very, very choppy. Okay, yeah. Right here. So, what do we see here? This is that's a swing low, no? Because it's a swing low, because it has the lowest low in between these three candles. Doesn't matter that it's a bullish candle, it's still the lowest low between these three candles, so it's still our swing low. Then once we've seen this displacement over here, all of this is considered a displacement, a bearish. All of this is our bearish displacement, right? So when we see a bearish displacement taking out this swing low, the first thought in our head is there is a shift in market structure, bearish. Shift in market structure, bearish. That's what we think when we see a displacement, a strong displacement like this one, over a swing low, a certain key point. So this is a swing low which gave us our bearish bearish shift in market structure, right? Because before we seen price traded to this level, we didn't know what's going to happen. Price could have gone up or down, we don't know. But once we seen it trade down below this swing low, that gives us our bearish shift in market structure, because price traded below this low, this one, not this one, not this one, this one right here. So let me just delete this real quick. And so this is our swing low which gave us the breaker block. So this is our swing low which gave us a shift in market structure, as you can see here. So this would become our breaker block. This right here is our bearish breaker block. Alright, and price has a gap right here, and look, the gap closes off where? At the bearish breaker. So if you can see, let me just change this color. Yeah, here is our bearish, is a fair value gap. So price will have a tendency to trade back up into this gap to fill it, and look what happens here. Price goes into our bearish breaker block level before repricing lower, targeting where? The sell side liquidity over here. And once it took out the sell side, what's the next step? You guessed it, to this buy side here. And there's the same thing happening over and over and over again. So this is our bearish breaker, and let me just write down exactly what you need to see for the bearish breaker. To get a bearish breaker. Alright. To get a bearish breaker. First, is a bearish displacement taking out a swing low. Once we see that displacement, we begin to think that market is bearish. Am I right? Yes, market is bearish. So the swing point or the key area which was broken, so the swing point or the key area which was broken now becomes our breaker block. So if price retraces back into the breaker block level, we can expect some sort of true resistance. And this is the true resistance, the breaker blocks and the order blocks. That's what they count as true resistance and true support. Not equal highs and equal lows, that's our liquidity. So again, one last time for the bearish breaker. Price trades below this key area as the swing low with a displacement. So this swing low which got violated by this displacement now becomes our breaker. So price will go all the way up to this breaker block level, and now it's acting as true resistance. As you can see, a couple wicks higher, but nothing crazy, before price went all the way lower, taking out this sell side liquidity. Okay, and finally, let me show you what a bullish breaker block looks like. So let's just go to the left really quickly. And yep, this is an example. What do we see here? First, let's just get this out of the way. So, because this really needs to be in your brain very, very deeply. Alright, so our structure here is bullish, excuse me. So before a strong bullish move, what you would want to see is a sweep of the sell side liquidity. We get that with this move here, taking out this sell side, coming in to fill these gaps, to fully fill these gaps with the candle, not with the wicks. And then next thing we see after price took out this sell side liquidity, we seen price trade above this buy side here strongly, one-sidedly, and in line with our bias being already bullish, this would create this area as our breaker block level. So let's just highlight it. This is our breaker block level from here to here, this whole area here. So price will go all the way up, giving us that displacement, that bullish shift in market structure, and making this our breaker block. We'll expect price to retrace back down into where this breaker block level before offering price higher. So this is the structure of a breaker block, what makes a breaker block. We have our bullish, price going up, price going down, retracing a bit. Then once we see this happening here, our bullish displacement, a strong one-sided bullish candle, and taking out a swing high, a key swing high, that creates our bullish breaker. This means this key swing high now is our bullish breaker. So let's mark out our breaker like this. Obviously price is gonna retrace, and once we see price retrace back into the breaker, this is acting as a level of support, true support, that price is gonna continue trading higher. And same thing happens now. Say price retraces, this now becomes our breaker block over here, because price traded higher, taking out this key swing high. So now this key swing high is our new breaker block, bullish breaker block. Price is gonna retrace down to this breaker block before going higher. Same thing here, price took out this key swing high, and our bias is still bullish because we haven't seen anything which makes us be bearish. So we'll come back down here. This would be our new bullish breaker block. Well, let's say instead of price coming down here to this breaker block before going up like this, let's imagine that the price took out this key swing high, and when it's retracing down, it didn't just stop here, it continued going down, taking out this key swing low. So what does that mean? And I hope you guys starting to get the hang of this. That means that this is now our bearish breaker block, because we've seen a bearish displacement going lower before price retraces back up into this bearish breaker block. That's it. The market shift from being bullish because of this move to bearish because we've seen a displacement, a bearish displacement lower, taking out this key swing low. So this would be now our bearish breaker block. So price would go back to this breaker block before trading lower. Two key areas like sell side liquidity, any gaps, any inefficiencies, or stuff like that. And yeah, that's it for lesson 4. I hope you learned a great deal of knowledge, and thank you for joining us this episode.